This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 418 was produced on March 7th, 2024. I'm Eric Townsend. Eurodollar University founder Jeff Snider returns as this week's feature interview guest. We'll discuss what the Fed's Waller really said last Friday, whether it really means another round of quantitative easing is just around the corner as markets are already celebrating, and then dive into one of Jeff's famous chart decks covering macro risks in all the major global markets.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, March 6, 2024. The S&P 500 March futures up 59 basis points to 5,111. While the primary uptrend is mature, the bull trend continues to be intact. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The US dollar index down 54 basis points, down to 103.35. The April WTI crude oil contract up 75 basis points to 79.13. We'll take a look at that chart in the post-game, and Eric will have the EIA inventory data. The April RBOB gasoline flat on the week at 255. The April gold contract up 568 basis points to 2,158, a breakout to all-time new highs. Copper up 78 basis points to 387. Uranium down 286 basis points, trading at 91.75 as the correction continues, and the U.S. 10-year Treasury yield down 16 basis points, trading at 4.10, a breakdown sending yields back towards 4%. The key news to watch is Friday's jobs numbers, and next week we have both the CPI and PPI inflation numbers, retail sales, and the Empire State Manufacturing Index. This week's feature interview guest is Eurodollar University founder Jeff Snider. Now, Eric, why did we get Jeff back on the show as a guest this week?
Well, Patrick, in addition to being Professor Eurodollar, Jeff is an astute observer of monetary policy, and he seemed a perfect guest to comment on what was actually announced last Friday and what it will mean for markets.
Well, Eric's interview with Jeff Snider is coming up as Macro Voices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Eurodollar University founder Jeff Snider. Jeff prepared a slide deck to accompany this week's interview. For any new listeners who haven't heard Jeff's interviews before, Jeff is famous for really detailed and complete slide decks. This week is no exception with 77 slides in the deck. We're not going to get to all of them, unfortunately, due to time, but I encourage all of you to peruse the entire deck. Jeff is famous for the quality of his charts and graphs. Jeff, it's been way too long. I think the thing on everybody's mind is I think there's a framework of macro everybody understood where the most important thing to watch was rate cut expectations, because if we had rate cut expectations coming out of the system, that had to mean down for risk assets. But all of a sudden, Fed Commissioner Waller said some funny stuff about what sounded almost like a reverse operation twist, and everybody's got a different mindset. And despite the fact that rate cut expectations are coming off the table this week, we've still got the melt up in everything, particularly gold and Bitcoin. So what's going on? What did Waller really say? Is Zero Hedge right that this is reverse operation twist? And if it is, what does that mean?
Oh, boy. I mean, Waller really opened a can of worms here, didn't he? As I was putting together the slide deck, I thought, boy, I'd have to redo all the slides just to go over this, because you knew it would be a topic of conversation. As you said, Eric, it's definitely something that people are wondering about, because it doesn't sound like it's anything the Fed has done before. So it's quite natural people would say, what is really happening? What did the hell did the guy even say? And all he really said was they need to rejigger their portfolio maturity, the Fed's portfolio maturity, to make it more like it was pre-crisis. That's the first part. Essentially, you go back to before 2008, the Fed's SOMA holdings were about a third treasuries, and the Fed specifically treasuries because they didn't have any other assets. And over time, they've through their various programs, they've had to extend the maturity in the portfolio, repeated QEs, in essence, to try to fool the marketplace into believing that there's actual huge amounts of stimulus going on. Then you go to 2019, we had all that funky stuff in the repo market, and the Fed not wanting to engage in a QE, called it not QE, but it really was. But in order to make it not QE, they ended up buying treasury bills. And that proved to be a bit of a disaster because demand for treasury bills was so high. And so you get to March of 2020 and the Fed realized that was a mistake. So they stopped buying bills. And so the bill proportion in the SOMA portfolio has really dwindled, forcing the Fed to buy lots of longer duration assets. And what Waller was saying is I would like to get back to more of a traditional style, or at least a pre-crisis allocation to shorter term duration. And then he mentioned some other things like what that would do in a future QE episode. It would allow the Fed to roll off treasury bills as they expire and then use the proceeds to buy longer dated debt, which would then allow the Fed to do QE as it sees it, but not actually expand their balance sheet. So there's a whole bunch of factors there where people are like, well, what the hell is this QT? Is this tightening? Is this an operation twist like 2011 and 2012? What is really happening here?
Okay, Jeff, you mentioned so that the Fed would be able to do QE in the future. It feels to me like Waller said some comments that he probably regrets now, alluding to just a possibility that if the Fed ever wanted to do QE again, this would help them be in a position to do that. I think a lot of people are jumping to the conclusion the Fed just announced QE is coming. It's a certain thing. It's around the corner. Is that what's going on? Is that how the market is perceiving this? And if so, is that how the market should be perceiving this?
Well, the question preceding those two, Eric, is that what Waller said? Because I'm not sure it was. I think he was really concerned more about the mechanics. And of course, now we're into interpreting the guy's words, which is always a fool's errand to begin with. But I think in my personal perception, Waller wasn't saying anything. What he was saying was basically, we would like to shift our portfolio back to a more traditional style of a portfolio as we see it. And this is the way that maybe the path of least resistance to do so. But Eric, I think you're absolutely right. The market took it as very different. And for a couple of decent reasons. You go back to 2011, September of 2011, when the Fed did the original Operation Twist. That was a bunch of bull crap too. They called it Operation Twist because they didn't want to do QE3 so soon after doing QE2. Remember, QE2 had finished up just a couple months before then, and the market was in a complete disaster mode. You had rates falling, you had stocks falling, you had the economy falling, you had banks nearly falling. You had the Fed talking about bailing out the repo market yet again. And so they did this Operation Twist, which was transparently another attempt to do a QE or some kind of stimulus as the Fed sees it. So you're thinking, okay, the Fed in 2011 does this Operation Twist, and here's Waller in 2024 sounding somewhat similar. It's understandable to an extent why the market would go nuts and thinking, yeah, the Fed is doing something weird here. Maybe they're doing another Operation Twist and they're changing up the parameters like either 2019 or 2011, just so that they don't have to admit that that's what they're actually doing. Now, personally, I think that's going way too far with what Waller's saying. I think that's overreacting. But as you're pointing out, Eric, there was absolutely a clear reaction in the marketplace. Gold, treasuries to an extent, and other Bitcoin, as you mentioned. I don't know if that was necessarily the market interpretation. Maybe there were some other factors. I saw some people talking about it unleashed a torrent of short covering in gold, perhaps. And it's always difficult to interpret short run market moves anyway. But there's definitely a correlation with Waller's speech. You could see that on the charts. But I don't think Waller said we're about ready to do QE. I don't think that's what he was saying at all. But you're right. I believe this morning he's probably regretting all of his statements to this point.
Let's go ahead and dive into your slide deck, which is titled The Landing Risks. Of course, everybody's been talking about, for a while, is it a soft landing or a hard landing or an outright crash? Now it seems like no landing is becoming the consensus, that the economy is firing at all cylinders and, everything's fine. There's no recession on the horizon and it's all clear sailing ahead. What is the data telling us about the economy, starting on page 3?
Well, that's the other part, going back to what Waller and the interpretation of Waller, you understand why some people are thinking, okay, maybe this is the Fed moving toward a QE-like program, because despite some of the outright euphoria over the economic situation, you're right, we're back in that no landing paradigm again. A lot of the data doesn't look anything like it. In fact, we have a clear, very clear bifurcation. A lot of statistics look like a recession, or at least look like the recessions that are spreading around the rest of the world. And of course, that's a big risk too. When you see the R word begin to be used more effectively in more and more places, not just Europe. Now we've got Japan in recession too. I mean, Finland just fell into recession. You see recession spreading around the world. You see the divergence in data inside the United States. And then you see Christopher Waller come out, and you hear Christopher Waller come out and say, we're going to do something weird with our portfolio. It's not that far of a leap to say, okay, what's really actually happening here? But I start from the position that we went through this no landing, soft landing recession back at the end of 2022, the early part of 2023. And we never really left that. We kind of go back and forth between recession and no landing or soft landing as the short run trends run their course. And I think that's one reason why the data looks like it does, where some of it looks really, really good and other parts of it look really, really concerning. In fact, they look a lot like what we see coming out of Europe, and Europe's been in recession for over a year. It's a difference in timing and in cycle where the timing is unlike anything that we've seen before. And a lot of that has to do with the labor market and labor hoarding. So the timing is out of whack. There's less familiarity with the cycle. And the U.S. economy in particular, there's a bunch of idiosyncrasies like automobile demand and automobile production, believe it or not. It has everything just feeling like it's out of whack. And so the default interpretation for most people, certainly risk asset classes, is that everything must be fine because it doesn't seem to be clearly not fine. And so the question is, does the data converge in one direction or the other? And so what I thought we would talk about, Eric, and you seem to be receptive to that, was what are the risks to the overall, not just U.S. economic situation, but the global situation? And we start out with just the U.S. economy. We go into the slides, second slide right away. You've got the mainstream media talking about how this economy feels like a recession to a lot of people, but it doesn't seem to be a recession. At least that's what the official statistics say, or at least the official statistics that everyone pays attention to. Yet at the same time, as I mentioned, overseas economies are just struggling really badly. Go to slide 4, GDP. I think everybody knows this. We're going to go through these really quickly because we don't need to spend a whole lot of time on them. GDP last half of last year defied all expectations, looked really good. A lot of it because of slide 5. Consumption expenditures were good. But where the downside comes in, we start with slide 6. Nominal GDP is slowing, and history shows that slowing nominal economies don't do so in a continuous fashion. Although they have so far over the last couple of years, at some point there's a risk that nominal slowing actually accelerates and becomes not slowing and becomes actual contraction. Whereas the Federal Reserve and most mainstream expectations is that slowdown levels off at a very nice, gentle pace. And we get into the soft landing and no landing. Slide 7, same with personal expenditures. Hopefully they level off. But where we start getting into the questions, I know a lot of people have talked about this before, slide 8. The difference between GDP and GDI, which has been a difference for going back over a year now, really back to the technical recession in the early part of 2022. GDP looks relatively good, but GDI says this looks more like a recession than not. And again, when you go to the slides in Europe, GDI looks a lot like the economic stats coming out of Europe, where there is more actual recession-like behavior than not. More diverging data in the establishment survey itself, slide 9. The payroll report, the last couple of them, especially for January and December, were absolutely terrific, well above expectations, way above expectations, in fact, suspiciously above expectations. Yet, in the very same survey, hours worked actually tumbled to nearly the lows of the 2020 crisis, which that tells you something's not right there. There's probably a statistical issue as well as underlying weakness. And you just keep going. Slide 10. Again, payrolls versus hours. There's a divergence going back to the middle of 2022, which is consistent with GDI versus GDP. The household survey versus the establishment survey, that's slide 11. And one of the common things that maybe you run across this too, Eric, I certainly have. People, when they describe the labor market, they're not necessarily talking about layoffs. If you go to slide 12, in addition to hours being cut, full-time job not being as plentiful as they had been before, there is definitely a hiring freeze. We saw a tick up in layoffs over the last couple of months, but more than that, it seems like companies have just stopped hiring. In fact, you talk to people in the real economy, especially white collar workers that have decent jobs, they're deathly afraid of the fact that if they do get laid off at some point, they'll have nothing. There's nobody hiring anywhere. And there is lots of data, and in addition to those anecdotes, which suggest the U.S. labor market, for whatever the case may be as far as layoffs, as far as hiring is going, it isn't going. It isn't happening. So businesses are taking active steps to control their costs, which is not the kind of situation you would associate with a no landing type scenario. That sounds a lot more like an economy heading toward recession. So you look at the JOLTS data, that's on slide 12, hiring has come way down. And then slide 13 is the reaction to hiring, which is quits, which has fallen off pretty dramatically. Both of those have really since last May. Just last couple of slides on the U.S. economy, 14 and 15, you can see how GDI actually fits some of the other statistics better than GDP does. In this case, S&P Global's U.S. composite, which doesn't argue for a sharp recession. It just argues for something that's closer to recession than this no landing scenario. Slide 16, you get into jobless claims. Initial claims look like the mainstream data, but continued claims, those argue for the hiring problems. When you do get laid off and you do get involuntarily separated, you tend to stay on unemployment longer, which is not a good sign as far as hiring goes. And then, of course, the risks to the economy don't seem to be inflation, despite the fact that the January CPI was a little bit higher than people had expected. That's slide 17 and 18. We get into in 19, we get into the CPI. The idea that much of the CPI is being driven by shelter prices and whether that's a real phenomena. Many people have noted that. That's what you see in slide 19. The all items in the CPI less shelter. It's been pretty much disinflationary and solidly so for over a year. So the question is whether or not you believe the shelter index is anything real. So just to sum up the first part of the slide deck here, the U.S. economy, the statistics that most of the public knows, GDP, the unemployment rate, payroll report, that kind of thing, they all look terrific. They all look fantastic. But even the survey data that they're drawn from doesn't agree with those interpretations. There is a solid amount of evidence and a growing amount of evidence suggesting the U.S. economy is very, very slowly working its way still toward the downside of a cycle. And I think that's the overriding part, the more anomalous part of all of this is how long it has taken to transition toward that downside of the cycle. But you look at all the data, it still looks like it is an economic cycle, especially when you put it in the context of all these other global economies or national economies around the world moving in the same direction.
Jeff, you caught my attention when you said that the labor data looked suspiciously better than expectations. What is it that you're suspecting?
The payroll report, especially for December and January, as I mentioned, and as you know, Eric, way, way above expectations. And even the most optimistic analysts were thinking nowhere near like what those were. But those two came with the benchmark revisions to the entire payroll series. So to my mind, and I think the hours number, which is right next to it on slide 9, is telling us that there's a statistical problem with the payroll report. And it has to do with how the payroll report actually comes out every year. Well, how the BLS puts together its seasonally adjusted numbers, how they attempt to smooth out the variations. And in this case, for last year's benchmark changes, they had to kind of revise down those payroll numbers from earlier in the year and then revise up the last couple numbers to try to straighten out the overall trend in the establishment survey. So what I think of, the part that I've got circled there on slide 9 on the left side, is I think it's a telltale sign of overly smoothing and overly adjusting the payroll series. And that's really what the hours index is telling us. In addition to weakness, real weakness in hours, there's too much statistics going on in the payroll report.
Now, Jeff, I usually ask our guests on MacroVoices to tell me what the risks are in the macro environment. I budget a minute or two for that. You've got 50 slides in two groups of U.S. risks, followed by a China economic backdrop, followed by China risks in, I've can't count how many slides here, followed by European risks. I have the impression, Jeff, that you think there may be more risks than the consensus perceives to exist in this macro environment.
Yeah, I do. And I hope you're giving me more than 2 minutes here to go through it, because I think this is the important part.
You got as long as you lead. Why don't we dive in on page 21 here with the first batch. Well, what's the difference between Group 1 and Group 2 of risks in U.S. risks?
Well, Group 1 is actually kind of two groups, and Group 2, as you'll see, is very different. Group 1, let's focus on that. That's basically banking, and I think one of the things that most people have their eye on, which is commercial real estate, which we all know is going to be an issue. We just don't know how much of an issue or how it's going to develop. When we start trying to look at what commercial real estate, maybe how it's developing and where it is, and maybe so we can figure out where it's going, let's look at what the banks themselves are doing. So the Federal Reserve's H8 statistics are the assets and liabilities of all the commercial banks in the United States. And you see, first of all, going back to last year, they've been hoarding cash again, which is a defensive sign. It's certainly a signal that doesn't look like banks are all that optimistic about a whole bunch of potential issues, but that's just a place to start. The banking system seems to be wanting to hoard cash, and it's a substantial change in their behavior dating back to last summer, which is when we saw a bunch of substantial changes in a lot of other things. We keep going forward through the bank statistics, page 22, you see all loans and leases. Basically, we're in a credit crunch situation, but not a horrible one. And so the risk here is that if banks do get triggered in some fashion or some way, if it is commercial real estate or if it's something else, maybe it's reverse operation twist, who knows, then this mild credit crunch becomes something more severe. And then what would the impact be on the general economy? And what would the impact be on the U.S. economy that may be weaker than people are appreciating given some of these other statistics? Same thing with page 23, one of the places where we start to see some more bigger impacts of the credit crunch, that's commercial loans. I've already seen credit card balances, non-revolving consumer credit balances are really weak lately. So that's an additional risk for consumer spending, which everybody has focused on the resilient consumer. We'll see if that holds up. Commercial and industrial loans, that's slide 24. That ends up being more of a cyclical indicator too. And again, it's the same sort of gentle credit crunch, not an absolutely severe one. And the risk is therefore, if it becomes a severe credit crunch, what does that do in the economy? But then slide 25, we start getting into the main event, which is commercial real estate loans. And thus far, banks haven't really done a whole lot about commercial real estate, which is, I think, consistent with the way the space has developed over the last year. Commercial real estate has sort of just been stuck. It's almost like everybody just waiting for something to happen, waiting for the first shoe to drop. And there was some concern, of course, as you know, Eric, back at the end of January and into early February with New York Community Bank Corp. And that would be the start of maybe some more disclosures, if not maybe some actions, because the real thing here is when you look at the data, we look at the statistics, and we'll go through a couple things here just in a second. There definitely is a problem. Commercial real estate had a huge amount of leverage added to it, that sector, in a very short, condensed period of time. And it did so under some pretty bad assumptions that are not holding up. Prices got crazy. And we all know what that means. That type of bubble behavior means there has to be a repricing at some point. And that repricing means somebody's going to have to take a loss. And really, there's going to be a lot of somebody's taking a lot of losses. We just don't know who, and we don't know how, and we don't know when that all comes out. But as I said, you look at the statistics. In slide 26, we're transitioning to the Z1, which is the Financial Council of the United States. Again, that's a Federal Reserve data. Multifamily residential mortgages, you can't really see it there, but if you go to the next page, slide 27, there is definitely a bubble type bump in depository institution lending in multifamily residential mortgages, which I think is consistent with what everybody's sense of commercial real estate was the last couple of years. And you can see that slide 28, bank holdings or bank lending in multifamily residential mortgages shot up 31%. In a matter of just, it was really about 6 quarters, which is an enormous increase in that space. So banks are absolutely exposed to that sector. Continuing with slide 29, this is commercial mortgages, not multifamily. These are the infamous office towers and retail parks that you keep hearing about. Again, there was a noticeable bubble The good news here, if you really want to focus on that, is that it's not as bad as certainly the residential mortgage real estate bubble had been in the prior generation. And in some respects, it's not even as bad as commercial mortgages had been in the late cycle period back then. But either way, it's still an enormous bubble. It is still a misalignment of fundamentals. And if we just keep going to slide 30, you can see once more that U.S. banks are the heaviest on the debt side into commercial mortgages. Go to slide 31, you can see commercial banks and how they're doing. But really, the big one is page 32. When we combine multifamily apartment mortgages with commercial mortgages, put those two together, you get about $1 trillion increase in a very short period of time, which is about 20% in debt, which is a huge allocation in terms of GDP. And again, as I said, bad assumptions, huge price swing. That's $1 trillion in additional debt that just underlies our basic sense that this was a out of control bubble period. And as the assumptions that went into it proved to be false, and we have to go through the revaluation process, there's going to be a lot of losses. So the numbers here tell us and verify that statement that there's going to be a lot of losses, that we just don't know who gets them and how it turns out. The real risk is that as these losses begin to be taken, it leads to the sort of fire sale forced liquidation process that leads into the worst of the worst case scenarios. Now, there's no reason to believe that that's the base case, that this commercial real estate problem becomes an uncontrolled, disorderly unwind, but it is a substantial number, huge numbers everywhere. And that is we can't discount that risk. And even if we don't get that far, we have just the revaluation that we see in these numbers as they are, that could lead to negative consequences in the real economy. As banks begin to book losses, they're not going to be in the mood to lend in commercial industrial loans or consumer loans. So that could actually spill over into the section I just said, which was the risk of a credit crunch, which is right now sort of a gentle and mild one, becoming a much bigger problem in that sense. So even if you don't have the crisis level of unwind in commercial real estate, it could lead to effects in the real economy too. And we shouldn't discount the probability that something like that could happen.
Jeff, before we move on to the next batch of a dozen risk slides that's coming up, I just want to talk a little bit more about what I feel is a complacency in credit markets, where it feels to me like most people are kind of saying, okay, maybe we're not going to get the cuts as quickly as we thought we were, but at least we know we're past peak rates. There's no way we're going beyond that peak again. I think that's way too complacent. So hypothetically, and this is not a forecast on my part, but hypothetically, if we ended the year with a 6% 10-year Treasury rate, is anybody ready for that? And what would it mean? What would the risk be if that happened?
I don't think many people are ready for that. And as far as what would that do in commercial real estate specifically would be really bad. Because one of the biggest problems that we're facing, and what everybody's really waiting for, is the refinancing, the wave of refinancings that we all know are coming. And a lot of these, at 6% rates, almost none of it becomes profitable. And if you're a lender, if you're an equity owner, none of it. Equity owners are going to walk away because they're not going to be able to afford to refinance at rates that are like that. So a 6% rate, if that were to actually happen, I think it would be a huge problem in commercial real estate, which would obviously increase the probability of that disorderly unwind, because then you would be left with what we're really worried about is that if banks have to repossess properties, what are they going to do with them? If they repossess a couple properties, that's maybe not a big deal because they can hang on to them as long as they have the balance sheet capacity and the wherewithal to hire, people to run them, which shouldn't be an issue. But if they start getting loaded with properties that they have to take over, they're going to have to start selling them, especially if they don't have the balance sheet capacity to do so. And at 6% rates too, there's not going to be a lot of buyers, which means the price pressures become even more of a pressure, being more of a negative factor. So no, Eric, I agree. There's no way the commercial real estate problem would not go into a bigger issue at 6% rates. So the question is that a realistic risk?
And do you think it is a realistic risk?
In my mind, no. I don't think that's where interest rates are going. And I think we're in one of those periods where I think we're over-interpreting moves in the marketplace. Because generally what happens after a huge bond rally like we saw at the end of last year, rates back up. That's just what they do. That doesn't mean the market is taking rate cuts off the table. It just means the market is reassessing the situation. And that's another problem too. The market does not forecast rate cuts. It forecasts probabilities. So at the end of last year, when interest rates were down sharply, and inversions were huge, and it looked like the curve was about to bull steepen, which is the worst of the worst case, that wasn't the market saying it expected 6 rate cuts in 2024. What the market was really saying is that there is a non-trivial probability that rates are 0 at the end of the year. And there's also a non-trivial probability that rates don't go all that far. And the median, so to speak, in between those two positions looks like 6 rate cuts. And so the probability distribution has shifted a little bit back toward rates remaining where they are and being less extreme about the downside. But even that I don't think is a function of anything more than just fluctuations in the marketplace. And so the general perception is really still, to this day, that there's more downside risk than there is a probability that rates stay about where they are, let alone go a lot higher. So unless something substantial changes that completely erases the way the market is thinking, and the market has been thinking this way for a long time, and nothing has changed its mind yet, it is still prepared for a substantial, more of a probability of rates going down and by quite a lot than rates going up by quite a lot.
We got 5 more slides starting on page 36 on U.S. risks.
Now, the other U.S. risk I think most people are really concerned about, as they should, is Uncle Sam. It's just been insane. It's just been absolutely incredible. The amount of debt that was issued last year with no war, no pandemic or anything else, it boggles the mind. The problem I have is that people then associate that with, okay, well, that's going to be hugely inflationary as one possible risk, or it's going to blow up the treasury market. When the evidence throughout history, not just recent history, shows it's actually not either of those. So that's what slide 36 shows. You look at the big increases in debt to GDP. As far as inflation goes, those tend to come during deflationary period or disinflationary periods for a couple different reasons. But focusing on the later silent depression, to use Emil's term, since 2008, 2009, that one's pretty obvious. The government responded to an economy that was falling off. And they did so in the textbook Keynesian way, which was to increase aggregate demand through deficit financed spending. And it didn't do anything. It didn't create a recovery. It just left a lot of debt on the books. But because of the lack of recovery, the negative fundamentals, in that type of situation, the marketplace demands safety and liquidity, which is U.S. Treasuries. So the demand for Treasuries perversely goes up, and which allows the government to continue its reckless spending ways. As Milton Friedman said in slide 37, deficits can contribute to inflation, but it really depends on the circumstances. The biggest problem with the sustained deficits is that it rewards irresponsible government spending because governments believe they are the solution to all the problems. And if they think the problem is the economy isn't working, what do? They end up spending more. So if you think that bond vigilantism is going to stop the government here, think that's just not happening. Because of the demand for safety and liquidity, the federal government has carte blanche to spend. And the problem that we saw over the last year is that politicians know it. They were kind of on the fence about it over the last 15 years. They were still kind of, Bush went too far in 2008 because he said it's going to be Great Depression too if we don't. Obama then, he was more careful and thought, well, I don't want to push it too far. Trump administration, same thing. But over the last couple of years, really since the pandemic, politicians have realized that there's no market penalty for their insane, reckless behavior. So as Friedman was pointing out, that's really the downside here. And as I would argue, and I think history shows, if you go to 38 or 39, what really happens is government spending, which is incredibly wasteful, incredibly irresponsible, incredibly unproductive, in the circumstances that we find ourselves today, that doesn't contribute to inflation. It actually contributes to more disinflation, if not deflation, because it makes the economy less productive, less efficient, and less of everything that we want and need it to be in order to be a recovery. So it actually contributes to slowing down the economy over time, maybe more so than anything the Fed does, sure. So even though there is a short-run sugar high to government spending, which may be why last year turned out to be as seemingly robust as it was, over the long run, it actually subtracts from economic potential because of how wasteful and inefficient it is. And then the last part of that, slide 40, you just see that over the last year, a little bit over a year, going back to the late 2022, as the amount of debt that was issued was just absolutely crazy. As I put in slide 39, we were talking about 3.4 trillion in new money last year. If you just thought of just intuitively, it would sound like prices on treasuries, the federal government's debt, would have had to have just absolutely collapsed. But the opposite happened. Instead, the market more than absorbed that treasury issuance. And in fact, rates are pretty much about where they were at the end of 2022. And that's despite not only the huge treasury supply, that's despite the fact that all the excuses you normally hear about the treasury market, none of them were happening last year. There was no QE. There was no change in regulation that forced, say, pension funds to own more liquid assets. There's actually Fed QT, not that that does a whole lot, but I mean, the Fed did about $1 trillion, a little over $1 trillion in just UST alone. And on top of all of that, the Fed hiked an additional 100 basis points at the short end of the curve. And yet, despite everything, the bond market is saying we took it all in and then some, which is itself, I think, another reflection of everything we talk about with economic as well as financial risks in the economy in the United States that may be weaker than people are appreciating, as well as the huge risks to commercial real estate that are, I mean, we all know it's going to happen. We all know that there's going to be some problems associated with it. And I think that's one of the things that are keeping the demand for safety and liquidity as robust as it is in the face of all of these things. And, again, don't shoot the messenger here. I agree with the idea behind bond vigilantism. I would love for the market to slam the door shut on the federal government, but it's not happening, and there's no reason to believe it's going to happen. The solution to the fiscal problem is obviously a political one. It's up to voters to demand something like that. But the sad part of it is that politicians have figured out they can buy votes. So what's going to change here?
Well, Jeff, let's talk about the mechanisms of how it would eventually come to a head, because I think ever since the 1992 presidential election, when Ross Perot made a big issue of the unsustainability of the national debt, any sane person can easily see, yeah, it's unsustainable. It's a great word, unsustainable. Well, what's the mechanism of the breakdown, and what's the catalyst that causes it to break? Because let's face it, as much as we want to get angry at politicians who just say, oh, deficits don't matter, the empirical data is they've gotten away with this for several decades now of just insane borrowing and spending and the national debt is, going up by trillions of dollars in a calendar quarter, or at least more than 1 trillion in a calendar quarter, which was a new record. It continues, and it doesn't seem like it breaks anything. Is this just all of a sudden something goes crazy and a 2008 happens overnight, or what? How does it break?
Well, I mean, you're exactly right. It sounds like there should be a breaking point. There should be a limit. But we've seen numerous counterexamples where it hasn't been. And you just mentioned we are living one. We've been dealing with this. We've been talking about it for a very long time. It really goes back further. It goes back to the 1970s, the second half of the 70s under the Carter administration. And then, of course, the Reagan administration actually outdid the Carter administration in terms of increasing the level of debt. Then there was that lull in the mid-90s. But was that really about Ross Perot, or was that just the economy outgrew the government? I think that was really what happened. The last half of the 90s was, the government didn't catch up to where they could have gone. Thank God. They could have gotten even worse, but the economy outgrew the deficits. And then, of course, in the 21st century, went right back into it again because the economy started to settle down and slow down. And then, of course, 2009, the economy fell off and government spending accelerated. So is there a mechanism that causes the federal government to come to its understanding that I don't want to use the word unsustainable, because history has shown that it actually can be sustained, which is the problem here. Because like I said, the problem with the government is that it's like putting its thumb on the scale of the overall economy. The more the central planners think that they have to central plan, the worse it becomes. And then the more the central planners have to central plan. It is the Japanese example. And the Japanese, of course, is the prime example for the sustainability of insanity for a very, very, very long time. You look at the Japanese debt to GDP, which is just the primary fiscal deficit. It's far in advance of what we have here. And of course, they have a secondary budget that's just as ridiculously insane. So I don't know if I would use the term unsustainable. I think that's actually I would prefer not to use that term, because I think we shouldn't fool ourselves into believing that there is a magic mechanism that forces everybody to come to a table and say, we need to stop this. I would think that, it has to be a grassroots effort where we force politicians to stop it by not voting for those who continue to do this stuff, by forcing people to realize that the long run downside harm is far greater than any short run benefit, whatever that may be, it actually is. I think it's a matter of realizing that, rather than thinking that somebody's going to do this job for us. We shouldn't be lazy about this and think that there is a magic moment where the light bulb just goes off in Washington. It's not going to happen. They've realized that they can get away with this, and so they absolutely are going to. You don't blame a shark for biting you, because that's what sharks do. You don't blame a politician for doing this if they think they can get away with it. And so the market has shown that they can get away with it. It's up to the public and the voters to stop them. And that's what I'm really afraid of, is that voters don't have the education and financial literacy to know that they should. And of course, anything in the mainstream everything is lined up against understanding that to begin with. Everybody thinks that government spending equates to economy anyway, that government reallocation is somehow a good and justifiable process. So I don't want to be that pessimistic, because it would actually be better if it was unsustainable. If it would be better if there was a trigger that just stopped it all. But I don't think we're going to get off that easy.
Well, that's exactly what my thought has been, Jeff, is I don't think it's unsustainable. I think that we're already seeing and have seen a very slow motion result, which is, as you said, it started in the 70s. Look, we don't have the economic conditions of the boom times of the 80s and 90s. We've got more and more people literally living in tents on sidewalks. And it's this slow motion decline in standard of living, which I think is set to continue indefinitely, and nothing ever blows up. And unfortunately, what you're saying, Jeff, if I really just kind of rephrase what you just said a minute ago, it's like, look, the one thing that we can look forward to is when the voters recognize that handouts from politicians are a warning signal that they should cause to vote those politicians out of office. That's not very compatible with human behavior, just in terms of how people react, especially when, a very small percentage of the population can understand these long-term effects. Expecting the voters to say, wait a minute, because I know that there's more people living on sidewalks in the 2020s than in the 1990s, that means that we should really question any politician who wants to give us more free handouts. I don't see that ever sinking in.
Yeah, I agree with you. That's the problem. That the downside risk is that voters never wake up. And it requires a lot of being able to act beyond self-interest, right? Because if you're the one getting the handout, you only want more of it. And that's quite natural and understandable. So yeah, I agree with you, Eric, that it's one of those not really catch-22, but it's a rock and a hard place. We would like the markets to do something for us, but the markets have shown that they're not really willing to do it. In fact, there's all sorts of perverse incentives for that not to happen. At the same time, depending upon the voting public, which has shown absolutely no tendency to demand fiscal responsibility. I mean, outside of some massive, effective educational program, I don't know what that would actually look like. So that's not really going to happen either. And I share your concern that nothing changes, that we just sit here. And that's where we are. I mean, it's been 15 years of lack of economic growth and massive government deficits. Those two things actually do go together, and nothing has changed outside of the pandemic period, which politicians looked at as validation of everything that they had done. So yeah, I share your concerns 1,000% that nothing will change. And that is the worst case.
Jeff, I so enjoy talking to you. I sometimes lose track of time. We've got a whole section on China and another one on Europe, and we're not out of time yet, but we're going to have to pick up the pace a little bit. So let's run through the China economy slides. China is so important by some measures. It's actually the world's largest economy, bigger than the United States. And boy, a lot of people thought once we got out of COVID that the Chinese economic machine was really going to go back into high gear. Seems like changing geopolitics, or I'm not sure what. It's a different picture than most people thought. So how do you see it? What's coming?
Yeah, I know. I wanted to include all of these slides and all these others because I think these are important risks that we should be aware of too. Not just the United States economy slowing down and commercial real estate. There's also foreign risks. and not just those economies that have already fallen into recession. As you mentioned, Eric, China is a big, important one. Whether or not it's the largest economy, it is the largest contributor to marginal economic growth, or at least it has been over the last several decades. So if China is really slowing down, it may be worse on a permanent basis. What does that do to the rest of the world? I can assure you it's not anything good. And that's one of the reasons I believe the bond market has been so steadfast in this demand for safety and liquidity. By bond market, I don't just mean U.S. Treasuries. You look at government bonds around the world, they're very highly synchronized for what are global risks and global perceptions. As far as China's economy goes, as you just hit the nail on the head, Eric, last year was supposed to be reopening. China was going to come zooming back to life, and that was going to cure not just a lot of Chinese problems, but a lot of global problems too. And it just never happened. And I think the important point about that is people understand and ask themselves, why didn't it happen? What was the real problem? Because the explanation was zero COVID. And if once the Chinese end zero COVID, it was just like flipping a switch. But as we've seen in a lot of different cases, it's never that simple. In fact, there are underlying weaknesses that really go back a long ways, that China's economic problems are far deeper than even that would that had everybody believing. So you look at all the statistics, they all look pretty much the same. You got a huge amount of economic volatility. So 42, 43, 44, 45, and all that, really into 46. A lot of economic volatility in China during the pandemic period, which makes sense. You see that around the rest of the world. But then outside of base effects in the statistics, nothing really picked up on the other side, which gets us to the real China risk, which is more and more last year as it became clear reopening wasn't producing the way it was supposed to. It led Chinese authorities to begin to panic. They're like, okay, we were willing to give reopening a chance here. And by the time we get to the middle of last year, they were already in, we need to start stimulating mode, which was already a huge sign that things were going the wrong way. And I think the biggest problem with China really goes to their banking system. Obviously, just like commercial real estate in the U.S., China has a massive real estate problem, which we're getting news about it all the time. There's something just today. China Vanke, one of the last investment grade developers in China, is running into a liquidity problem. So you can understand why China is more and more panicky. At the same time, China's banking system is acting like a Western banking system, becoming more and more risk averse. The more the Chinese government does, this is a shorthand I always use, the more the Chinese government does, the worse you know it is. So that's really what these slides are telling us. The Chinese are starting to do a lot of stuff. The PBOC balance sheet expansion, and then the credit statistics beginning in slide 54 shows that the banking system is ignoring all of those inputs from the monetary policy from People's Bank of China. Just banks are slamming the door shut, which goes, economic risk as well as property bubble and other type of risks too.
Jeff, let's move on to Europe. Boy, the migrant crisis is causing so many both social and economic distortions. What's going on in the European economy, and where are the risks there?
The risks are that the recession that Europe has been in for over a year now, as we've been saying, nothing changes, because whether or not we have 2 straight quarters of negative GDP, that's not really a recession. It doesn't really matter. They've had negative growth across the entire euro area for 5 consecutive quarters, even though this hasn't been continuous, nor has any one of those quarters been really ugly and bad and horrific. 5 quarters is an enormous period of time to go without economic growth in real terms. And so you add those political pressures that you just mentioned to an economy that's already suffering, and one that you can see in slide 65 that never really came close to coming back after the pandemic in real terms, which means actual activity and volume. Europe's in a really bad shape, much far worse than any place else. China, the United States, of course, obviously comparison there. And one of the worst cases in Europe is Germany. Germany is just a complete, utter mess, and it's getting worse. And again, it's not about a massive, 4 or 5% drop in GDP during a quarter. It's even worse. It's a slow, gradual, grinding decline that does not want to end. And so that's the worst case that we keep going, because time is the biggest factor here. And Germany is just a complete and utter mess. So the risk here is that it actually does get worse. Not only is there the danger of nothing changing, you go to slide 70, you start looking at the banking statistics, and banks in Europe are behaving in the same way that we see in the United States. There is a growing and consistent credit crunch that has all the same hallmarks of a slow burn, a gentle decline, a gentle credit crunch that could become a more serious one at some point. And so what does the economic case look like if banks start to cut back even more? Or even they don't even need to cut back a whole lot more for the European economy, which is already experiencing a substantial, prolonged recession, to become even more prolonged and maybe even further to the downside. So there's an enormous economic and financial risk just from Europe, the way it is already.
Well, Jeff, I appreciate the rapid fire on those slides. I do encourage our listeners to take your time and peruse the full deck because there's some really great graphs and charts here. Jeff, for any of our new listeners who are not already familiar with Eurodollar University, a project you and I started originally just as a series of podcasts here on MacroVoices, you've grown it into something rather amazing. Tell us all about it.
Yeah, that starts with, you're right. I mean, we go back to 2017 when we started talking about Eurodollar University and putting it together in some more of a formal format. Well, it's taken me a few years, but I finally got it done. In Eurodollar University, we go over the Eurodollar system, what money is, what banking is. Why do we spend so much time with bond markets and financial curves and signals and what they're telling us? So we're looking at the macroeconomy, the financial system from the perspective of all of this Eurodollar stuff. And so Eurodollar University, as far as the content that we provide, I have a YouTube show almost every day, 6 days a week. We go through some macro or monetary event, again, through the Eurodollar perspective. And then we also have subscriptions and memberships available. Eurodollar University membership is really about the background detail, understanding where all this stuff came from and why it matters. And then we do more subscription. I have a daily briefing where we talk about the day's macroeconomic news and market movements. And then finally, a deep dive analysis subscription where we go very deep into all of these topics to really understand, first of all, where they came from, and then hopefully give us a better sense of not forecasting, certainly not predicting, but having a better sense of the probabilities of maybe where all of these things are going in the future. So that's Eurodollar University in all its various parts.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to get an update again from Jeff Snider. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's jump to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the button over Jeff's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA posted a build of 1.4 million barrels of crude oil, Cushing, Oklahoma building 701,000 barrels. But those builds on crude were offset by much larger drawdowns on finished products. Gasoline drawing down 4.4 million barrels, distillates drawing down 4.1 million barrels, for a net petroleum products drawdown of 7.2 million barrels. U.S. production ticked down 100,000 barrels to 13.2 million barrels, plateauing, it seems, at 13.3 million barrels. I'm pretty sure 13.3 is still the record high print. There might have been 1 week at 13.4. I can't remember. But this is a second round or third round, if you count pre-pandemic, where we got to 13.3, and that's where things seem to be kind of petering out. So it'll be very interesting to see whether or not it's possible to sustain any growth in U.S. production beyond 13.3 million barrels per day. Moving on to the flat price, it's still out of whack with time spreads, but it looks like maybe the flat price is finally starting to rally to follow time spreads higher. It seems like we keep failing right at $80, right around that psychological round number of $80 on WTI. If we can get above it, stay in the 80s, maybe we'll have a real rally soon enough.
Eric, the one thing I just want to highlight in oil is that it still remains relatively accumulated and bullish. It's above its 50-day moving average, making higher highs and higher lows. But there's been certainly a lack of follow-through on any breakouts. I now am rounding in that 79.50 to 80 area. Any legit breakout into the 80s should spur a $5 advance into the mid-80s. But right now, it really has been over a month of just a more of a sideways grind. It'd be really interesting to see if a catalyst emerges to drive that breakout. Now let's move on to equities. I want to get Nick involved in conversation. Nick, what levels are you watching on the S&P?
Spot price right now on SPX is approximately 5,100. The call wall right now, it resides at 5,200, and the put wall resides at 5,040. The implied move for next Friday's March 15th monthly OPEX is plus minus 90 points. Therefore, the upper implied move is 5,190, and the lower implied move is 5,010. Right now, we have key resistance at all-time highs at 5,150 area and key support at 5,050. So this week we popped to that all-time high level of 5,150 and then promptly sold off down to 5,060 area before popping back up on Powell's commentary, which I believe was a bit hawkish. Right now, what I see is a possible touch of that 5,200 mark area, but I'm bearish in the short term toward that 5,000 level, which if broken could send us down to 4,800 or so.
Yeah, when we're looking at that S&P chart, I just have it on page 4. You can see the upwards channel that I drew on. That's been the primary trend since the start of the year. And this has been primarily driven by just a few handful of stocks. The market breadth remains down around the 60% level, well off of the December levels near 87% as the breadth of the market continues to deteriorate. It's no more evident than by looking at the Mag 7 stocks, which I have on page 5. And while everyone's been talking Mag 7, we now have distinct technical breakdowns in Apple and Google and Tesla. And now Microsoft put in a pretty good reversal breakdown in the last few days. And so we have now literally only Amazon, Meta, and NVIDIA holding in. And even then, Amazon's not really contributing to the any of the upwards pressure. Now, this morning, NVIDIA is continuing to gap higher, now up at the 900 level. Increasingly, this is all about a Mag 2, which is when will Meta and NVIDIA run out of momentum? And is in my mind, when NVIDIA does ultimately peak out, and it could be at much higher levels, it could be over 1,000. I'm not in any way saying this is today, the day, but when we see NVIDIA finally peak out, I increasingly believe that that will also mark the swing high of the markets. And so we'll see how long NVIDIA can keep this party going. And when we do reverse, exactly like you were saying there, Nick, is that if we do break this trend line, the 5,000 level will be where roughly the 50-day moving average is, and you'll have approached some different fib retracement zones there. But if we break below the 50-day moving average, which is a moving average that's held since November, then it could mark the beginning of some mean reverting correction, and ultimately that would be of the 400 plus point variety if it was to get underway. And so watching where and how far NVIDIA goes is, I think, a very big key to the theme. Moving on, Nick, what levels are you watching on that Nasdaq 100?
Right now in the Qs, spot price is approximately 437. We have a call wall just above at 439 and a put wall below at 425. The implied move for next Friday's March 15th monthly OPEX is plus minus 10 points. Therefore, the upper implied move is 447 and the lower implied move is 427. Right now, we have key resistance at all-time highs of 440 and key support just below at 430. Now, I'm inclined to think, again, that we perhaps roll over and see a touch low of 420 in the short term. I am bullish on certain names, as you mentioned with the Mag 7. I'm actually kind of bullish on Apple on this decline, predominantly because I view them as being a little bit cheap. And I think that they're actually going to be a much larger player in the AI arms race than a lot of people believe, primarily because they have all of our personal information. They've been collecting that for the past 20 years, roughly. I'm also kind of bullish as well on Google because the valuation is kind of cheap as well. So that's my kind of opinion on those two names. But overall, broad market wise, I think we can see, at some point in the next few months of 400 or so after we hit that swing high on the peak of NVIDIA as well.
Nick, I find it a little bit interesting that on the volatility index that even though we've had a couple days of strength, volatility is definitely approaching still multi-day highs. What's your take here on the VIX?
Yeah, so right now with the VIX at approximately 15, the intraday implied top to bottom range is approximately 1%. We're seeing a lot of put selling on pullbacks and call selling on pops, and I don't foresee that to change in the immediate future. So right now, I'm just kind of neutral, watching and waiting to see if we break above that 5,200 mark, and also if we break down below that 5,000 level, which is a key area. If we do break that 5,000 level, I do see a lot more put buying and insurance buying pickup. That would cause a VIX spike in the short term as well, toward probably around 17 to 20 approximately. Now, moving on to the US dollar index on page 8, I'm curious as to your thoughts here.
The key technical level on the Dixie has been 104, and we were teetering right along it, just barely below it for quite a while there. Just in the last couple of days, we've seen a pretty pronounced breakdown lower, still above 103 as I'm recording, but just barely. And it looks like maybe a move lower is upon us.
Yeah, Eric, we've certainly seen some U.S. dollar weakness just in the last week. Especially, we just saw the yen rally considerably as the U.S. dollar yen broke. And that is certainly spurring some interest as to whether or not this dollar pullback can go deeper. But it really is going to be the ECB today that is going to potentially give a big tell. The euro is trading right at the 109 level, and this kind of 109, 109.5 level in my mind is a level where if the euro fails here and breaks back down, then the U.S. dollar advance is still very much in play. And so my eyes will be on that euro and the reactions after the ECB speaks today.
Now, moving on to page 9, we have that gold futures chart. Eric, what are your thoughts here?
Well, finally, it seems the long-awaited breakout to new all-time highs above 2,100 is upon us. And as so long as it doesn't reverse course and turn into a fake break, this means we've confirmed a positive completion of the long-term cup and handle pattern that began in 2011, greenlighting a new upside target of 2725. But let's not forget that when we're talking about long-term patterns like this, we need to see a move sustained for weeks in order to confirm that that's really happening. So initially, we've got the few days here of action above 2,100. The rally looks brisk. It seems to have legs. No signs of a reversal yet. If it holds and continues to hold for the next few weeks, stays above 2,100, then it would seem like it's game on for higher numbers. But what brought this on was clearly Waller's comments on Friday. The PCE data on Thursday morning got the rally started, but it was really the interpretation of Waller's comment to mean that some form of QE or reverse operation twist is in the works that really set gold on fire. So the big risk now would be if the Fed walked those comments back and said, oh, no, that's not really what we meant. Now, Jeff Snider and I already agree that that's not what we heard Waller say, and we thought maybe some kind of comment to walk it back might be coming. But the Fed has had almost a week now to make a statement if they don't like the way the market interpreted Waller's comments, and so far they haven't done that.
Yeah, Eric, this is as legit of a bull breakout as you get in terms of not only did we break to new highs, but it continuously followed through afterwards, and the buying has been relentless. Obviously, there will be dips along the way, but in my mind here, any dips that are like of the $50 variety should attract buy-on-dip traders right away. If we see that pattern, I think 2,300 is a very reasonable upside target for bullion.
Now, we have uranium on page 10. And continuing on last week's conversation, Eric, what are your thoughts here?
Well, I said last week that I thought the correction in uranium brought on by thin liquidity trading in the spot market might be ending. We had a massive bounce of over 10% in some uranium mining issues on Friday morning, but it may have been a dead cat. Some issues retraced most of that upside, and SPUT, which is intended to track the spot price, even put in a new lower low on Tuesday. But it was only just barely lower, and that lower low didn't beget more selling and accelerate the downside move from there, and it's just barely started to recover, but again, only just barely. At this point, the technical levels have turned south on several of the charts, suggesting that we may have just seen a dead cat bounced off the 100-day moving average and that a test of the 200-day moving average, which is still about 10% lower than the present market on the spot price of uranium, might be in the cards. I sure hope that we'll get that test because I'd love to add even more to my longs at a more attractive price. So to my thinking, the jury's still out on whether the correction is just finishing up its final bottoming pattern or if another leg lower is still to come. Some of the charts like SPUT and URNM look pretty bearish, but the charts for some of the individual mining shares look like the bottom is probably already in. Only time will tell, but my fingers are crossed for another leg lower so that I can add to my long position. My bullish conviction couldn't be stronger in the medium and long term, so any further short-term weakness will be a welcome opportunity to lever up with more uranium mining shares. Also noteworthy is SPUT, the Sprott Physical Uranium Trust, has traded at discounts to NAV even deeper than 15% in the last week. It's awfully hard not to take advantage of an opportunity to buy physical uranium 15% below already low spot market prices, especially when it's only another 10% or so below that price before the metal itself hits its 200-day moving average, which I'm pretty sure is going to be where the bottom ends up being if we haven't already seen it.
Now, Eric, I did put that discount onto the chart. It's showing here that we're trading over a 15% discount from uranium spot price to where the closed-end fund of the Sprott Physical Uranium Trust is actually trading. It has been at these discounts before, and we have seen that discount actually close and narrow, but it should naturally always trade at a discount, so it'll be really interesting to see whether that gap closes to less than 10% on some sort of a bullish reaction.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, Jeff Snider's slide deck, and the chart book we just discussed here in the postgame, including a link to a number of articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K. And follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.